Welcome, everyone. Today we are going to crack the code on your Indian salary. We're going to give you a playbook that'll help you navigate the system and really maximize your wealth for 2026 and beyond.
You know that feeling, right? You get that offer letter, you see that big, juicy CTC number, and you get excited. But then, that first salary hits your bank account, and you're kind of left wondering, wait, where did the rest of it go? It's a super common frustration, but the good news? It's a puzzle you can solve.
See, here's the thing you need to know. Your salary isn't just one static number. The best way to think about it is like a powerful engine. And the coolest part? It has levers. Levers that you, personally, can control to get either more cash in your pocket today or to build some serious wealth for your future.
Okay, so let's get into it. Here's our game plan for today. First, we'll break down the three main levers of your salary. Then, we're going to compare two totally different strategies, going for a high PF versus a capped PF. After that, we'll expose a really common pitfall I call the variable pay trap. We'll figure out how to choose the right tax regime for you, and we'll wrap up with an awesome pro tip, the VPF Secret.
All right, first up, let's get a handle on your toolkit. These are the three fundamental controls you have over your salary. Once you understand these, everything else starts to make a whole lot more sense. So lever number one, your basic salary. Think of this as the anchor for your entire salary structure. It's usually about 30 to 50% of your CTC, and it pretty much determines everything else. Lever number two is your Provident Fund, or PF, basically your forced retirement savings. And the third lever is the tax regime, that big choice between the old system with all its deductions and the new one with its lower tax rates. Okay, now for the fun part. Let's see how playing with these levers, especially your basic and PF, can send you down two completely different financial paths. Let's put them head to head. So on one side, you've got the high PF strategy. Now this means you'll see a little less cash in your bank account every month, but you're building up this massive pot of gold for retirement. Then you have the capped PF strategy. This puts the maximum amount of cash in your hand today, but it also means that saving for retirement is completely up to you.
So let's look at the numbers for the high PF structure. Here, the basic is set at a high 50% of your CTC. Take a look at that 30 lakh CTC row. Your monthly take-home is about $1,86,000. Why? Because a pretty big chunk of your salary is being automatically saved and invested for your future.
Now, check this out. This is the complete opposite. With the capped PF structure, that same 30 lakh CTC suddenly gives you a take-home of over 2,14,000. That is almost 30,000 rupees more in your pocket every single month. It's because your PF contribution is capped at the tiny minimum of just 1,800 rupees.
But here's the catch, and it is a massive one. That extra cash you get every month feels amazing. I get it. But it comes at a huge long-term cost. Over a couple of decades, that high PPF path can lead to a retirement fund that's literally crores bigger. It really is the ultimate financial question. Do you want more cash now or more wealth later?
All right, let's shift gears and talk about something that trips up so many people. It's the variable pay trap. It's that part of your salary that makes your CTC look bigger on paper, but can really mess up your financial planning if you're not careful.
Okay, picture this. An email pops up in your inbox. Congratulations, you've been awarded a performance bonus of 2 lakh rupees. Awesome, right? Your mind immediately starts racing with all the things you could do with that money.
But then, the money actually lands in your account, and it's more like 1,40,000. So what just happened? Well, you just walked right into the trap. The tax man took a big slice of your bonus before you even got to touch it, because bonuses get taxed right at your highest income slab. Ouch.
So here's why it's such a trap broken down. First, like we just saw, it gets taxed heavily right away. Second, and this is so important, not a single rupee of that bonus goes into your long-term PF savings. And third, it means your reliable, guaranteed monthly income is way lower than your total CTC number implies. So you've got to be careful not to base big decisions like an EMI on that inflated CTC figure. Okay, so now that we know about all these moving parts, let's put together a game plan for that third big lever, choosing your tax regime. This is not a one-size-fits-all answer, and picking the right one can literally save you lakhs.
You know, most of the time, the advice you hear is just go for the new regime. The rates are lower. But what happens when life changes? What happens if you're earning well and you decide to buy a house? Well, this is the exact moment when all that standard advice can get turned completely upside down.
This little table makes the logic super clear. If your CTC is under 15 lakhs, yeah, the new regime is pretty much a no-brainer. If you're earning over 20 lakhs but you don't have any big deductions, you'll probably still stick with the new regime. But, and here's the big one, if you are a high earner and you have a home loan, the old regime suddenly makes a huge comeback.
So the main takeaway here is really simple. The power to deduct that massive amount of home loan interest you pay every year under the old regime is an incredibly powerful tax-saving weapon. For a high earner with a mortgage, it often blows the benefits of the new regime's lower rates right out of the water.
Okay, before we finish up, I want to leave you with one final power move. This is a little secret that financially smart people use to get the best of both worlds, especially if their company has them on a capped PF structure. It's called the Voluntary Provident Fund, or VPF. Basically, it's a feature that lets you go to your employer and say, hey, I know you only contribute the minimum to my PF, but I want to put in more. And you can choose to contribute all the way up to 100% of your basic salary.
And here's why this thing is an absolute secret weapon. First, you got a high and really safe interest rate, around 8.25% right now, which is better than most fixed deposits. Second, it has what's called EEE status. That's exempt, exempt, exempt. In simple terms, the money you put in is tax-free, the interest it earns is tax-free, and the money you take out at the end is, you guessed it, tax-free. It's the perfect, rock-solid, safe portion of your overall investment plan.
So there you have it. We've taken apart the engine of your salary. You know about the levers now, your basic, your PF, and your tax regime. You know the strategies, the trade-offs, and the traps to avoid. So the real question is, now that you have the playbook, what's your next move going to be? Which lever are you going to pull first to start building your own financial future?